it really has two halves, the trust and the transaction. See, together they form the Fundraise Formula. And when you understand both, you can diagnose exactly why your raise is stalling and what lever to pull to get capital moving back to you better than ever. Why do fund managers close oversubscribed rounds in days while others chase investors for months, getting nothing but maybes? Well, the answer has nothing to do with your IRR, your deck, or even your data room. What it really comes down to is one simple equation that I call the Fundraise Formula. So I'm going to show you how this formula works mathematically, psychologically, and strategically so you can engineer trust and make capital flow to you. And stick around at the end because I'm going to give you this Fundraise Capital Diagnostic tool. It's a private framework that I use, and you can use it too to score yourself and your fund on how investors truly perceive you. It's going to change the way you raise forever. Here we go. Finance is more about trust and transactions. If you ask for the transaction before the trust, you'll likely get neither. But if you go for the trust before the transaction, you'll likely get both. See, every successful raise, every investor check, every oversubscribed round follows one universal law, which I like to call the Fundraise Formula. Now, what I want you to do, if you can and it's safe, draw this out on a piece of paper, okay? So the numerator is the probability of deal success raised to the power of what it means to them personally. Then multiply that by the valuation at exit. Great, you got the numerator. Now, the denominator, divide all of that by perceived risks divided by time to liquidity. And that's the math behind the belief. It is, and we use it to diagnose all of our deals. And it really helps us just on a qualitative basis to say, how are we being perceived? How are we building trust, destroying trust? How are we explaining the risks or not explaining the risks? Do they understand when we're successful, what that's going to mean to them? So there are a lot of variables that go in, but ultimately it comes to multiplying the trust first by the transaction. All of that is to make capital flow to you. And you see, most people skip that first part, the trust. And they just go straight to the transaction. And that, my friends, is the problem. But those who master both, they don't chase capital, capital chases them. So let's break that down. I want to tell you a quick story that just illustrates this. See, when Ray Dalio started Bridgewater Associates, he didn't have billions under management. He had a few loyal clients who believed in his ability to navigate markets differently. See, Dalio built that belief by writing deep, transparent market memos before anyone was even paying him to do it. See, he built trust first through clarity, competence, and consistency. And the results? Bridgewater became the world's largest hedge fund with over $150 billion under management. See, he didn't start with transactions. He started with trust. And that's exactly what this formula teaches you to do as well. See, the Fundraise Formula, it really has two halves. The trust, that's the emotional and psychological part of your pitch in raising capital. And the transaction, that's the financial and the mechanical. See, together they form the Fundraise Formula. And when you understand both, you can diagnose exactly why your raise is stalling and what lever to pull to get capital moving back to you better than ever. So when an investor meets you, their first thought isn't what's the IRR? It's, can this person actually pull this off? That's the probability of deal success I mentioned before. Think about someone like Blackstone's Steve Schwarzman. When he started raising for his first fund, he wasn't selling deals, he was selling certainty. And he showcased his track record at Lehman Brothers, his team's pedigree, and their network that gave them the edge. That's why investors leaned in. They believed the probability of success was really high. To increase your perceived probability, you can build out things like market dynamics, know your macro, your story, know it cold, your team and board strength. Surround yourself with proven executioners. And what we like to call the 3 R's or R3. That's your reputation, your relationships, and your results. How are you showing up? Do they understand that well? Showcase your real wins, real people, and real proof. And you can use case studies and early traction. You can show that the machine is already turning. See, when investors see momentum, they don't feel like they're taking a risk. They feel like they're catching a wave. And that, my friends, is the difference. See, the next piece is what I like to call the emotional exponent. In the formula, it's the power that multiplies belief, the probability of success raised to the power of what it means to them. Let me give you an example. Let's take a look at Kathy Wood at ARK Invest. Her investors don't just invest in ETFs, they invest in her conviction. She tied her investment thesis to human progress, innovation, freedom, the future. That meaning resonated deeply, especially during ARK's meteoric rise. So for your fund or your deals, the same principle applies. Investors must feel what the win means to them. Freedom from work stress, more time with family, building legacy, playing in the big leagues. See, once they connect emotionally, trust compounds exponentially. Hey, if you're finding value out of this discussion, could you do me a huge favor? Could you just take a second and hit that like or subscribe button? It costs you nothing, but it tells the algorithm that this is valuable information, and it helps us to get it to more people. Thank you. You're incredible. Now let's get back to the show. The next factor is the perceived risk. And I mean perceived by the investors or potential investors that you're pitching. It's the deal killer hiding in plain sight. See, investors don't fear risk. They fear unknowns. And if they can name it, they can manage it. And let me give you a story to illustrate this. Howard Marks of Oaktree Capital, he talks about this constantly. He says, you can't predict, but you can prepare. That's why Oaktree wins. They disclose, they explain, and they prepare. You build trust when you acknowledge volatility instead of hiding it. Show contingency plans for tax, legal, compliance risk. Own your weaknesses before investors find them, and communicate proactively. Transparency turns perceived risk into perceived readiness. Every risk you name strengthens the trust denominator, and it does it in your favor. So now that we've built trust, let's move to the transaction side of the formula. This is where you talk the numbers, the valuation, the return, and all the financial logic. Think about someone like Ken Griffin at Citadel. His entire pitch from day one is, I don't guess, I calculate. See, he used real-time data to show investors how their capital would compound under his models. That's credibility through quantifiable valuation. So for you, strengthen this by leading with what we call the bluff or the bottom line up front, stress testing your IRR and your NPV, being explicit about tax and legal structure and its efficiencies, and listing your assumptions so nobody wonders how you got there. See, when investors can't poke holes in your math, they can finally focus on your mission. And that, my friends, is key. And lastly, investors care about one thing. When do I get my money back? See, time to liquidity is the silent deal killer. If the wait is long, the trust must be even stronger. Let's take a look at Brookfield Asset Management. They handle long-term infrastructure deals, sometimes 10 to 20-year horizons. How do they keep the LPs patient? They do it through impeccable communication and milestones, regular updates, clear cash flow cadences, and visible progress on their deals. You can't shorten the time, but you can shorten uncertainty. Every clear update buys you more trust with your investors. So let's bring this all together. Trust times the transaction equals the Fundraise formula, or written out, probability of deal success raised to what it means to them personally, multiplied by the valuation at exit. All of that divided by perceived risk times the time to liquidity. See, when you strengthen the trust half, the transaction half becomes effortless. Think of someone like Chamath. I love him or hate him, he mastered this early. He built trust through storytelling, aligned outcomes to personal meaning, and positioned his deals as inevitable. When that alignment clicked, capital flowed like wine. So here's your next move. Stop guessing and start diagnosing. Go to go.fundraisecapital.co/the Fundraise Formula and download the Fundraise Capital Diagnostic Tool. Here you can score yourself and your team using this framework and ask yourself, as we pitch, do investors believe we can execute on what we're saying? Do they connect with what our success will mean to them? Do they feel our transparency on risk? And do they see a clear path to liquidity? Because if they don't know you, they can't flow you. And in high finance, trust isn't luck, it's leverage.